Could Clover Health be a good investment? Let's find out in about 5 minutes. My name's Brian Feroldi.
And my name is Brian Stoffel.
And this is a summary of a deep dive that we did on Clover Health to give you the key information that you need to know. So what is Clover Health do? They are focused on the U.S. health insurance market, which is a massive market that is broken in its current form. The incentives are all over the place. The data is not easily accessible, and there's an incredible amount of waste in the system. Clover Health is really pushing hard to fix all that. The way that they do that is with this innovative tool that they call the Clover Assistant. This is really a data aggregation tool that uses machine learning to help physicians make better decisions. Pulls in data from primary care charts, from specialist charts, from electronic health records, from lab data, all into an easy-to-use platform that then uses machine learning to spit out evidence-based protocols that physicians can use and patients can use to get better health. If they do that properly, there's a lot of advantages. So there's fewer hospital visits for the patients. That allows Clover Health to pass on the cost savings to patients in the form of lower premiums and lower copay costs. And they also have extra money to give to primary care. So doctors love it, patients love it, and it really seems to improve everything about healthcare.
So beyond that, what's the bull case for them? The biggest one is that this is a huge opportunity. They got their start in Medicare Advantage, which is a $590 billion market. They're moving into Medicare, which is worth over $1 trillion. But really, when you think about it, they could roll this out to all healthcare plans if they're able to execute. They are clearly taking market share. They're only in a couple markets, but back in 2013, they had 0 market share. And in the markets where they have been established for a long time, they have over 25% of the market share by the end of 2020. And there are naturally high switching costs inherent in health insurance, and those high switching costs provide a moat around the business.
Lots to look forward to, and the potential of this company is huge, but what can go wrong? Well, first and foremost, soon after this company came public, a famous short seller called the Hindenburg produced a scathing report about this company that blamed them for potentially doctors receiving kickbacks for using the Clover Assistant, and there's also been some turnover in the C-suite. Neither of those things are good news. Also, the company's financials are currently a mess. They are investing so heavily in their technology that they're not profitable. Over the past year, their earnings per share lost was 13 cents, and they produced negative $58 million in free cash flow. So there are some things to watch.
So when we ran this through our frameworks, the question was, is this investable? First, we ran it through Brian's Feroldi quality score, and it got a 68. And if you look at it, that's right on the edge, but he says, why bother with a company like this at this point? Conversely, when we ran it through the anti-fragile framework, it got a score of a 10. And if you look at that, that's actually solidly in the investable, robust range. Now, Brian, one thing I'll say is you're very clear that there's a lot of room for improvement that could happen relatively quickly.
One downside to my framework is that it unfairly punishes new companies to the public market because I like to see a track record of success for the stock once it comes public. I like to see things like the management team is executing and beating expectations. And I also still am getting to know the business and its fundamental advantages. So because of that, my score is naturally lower for IPOs. I could easily see this company raising its score over time as it continues to scale, as it becomes profitable, as investors get to know it more. So I could easily see this company being an investable idea. Could your score improve?
It could. And what I will say is the moats are narrow, but they're widening around it. Really, this all comes down to what we'll see in the next question, which is how effective is the tool that they're offering? So why don't you cover what we're going to watch?
Yeah, that's fair to watch. So the things that investors need to watch moving forward is that Clover Assistant tool, right? That is the key technology for this company. And if doctors do continue to find it to be very useful, and it can also lead to cost savings for patients, it seems like a win all around. But that's something that investors need to watch. Another thing to watch is the short seller report that Hindenburg put out. Are those claims credible, or will they prove to be just smoke and mirrors? Third, can they replicate the success that they've had in their early markets elsewhere in the United States? The odds look favorable that they can, but there's no guarantees of that. And then finally, how long is it going to take this company to scale to the point where it's actually producing free cash flow and profits? It's got to be a risky proposition until then. If you want more information on Clover Health, Brian and I did an hour-long deep dive on this company where we went into far more details. So click the link that you see to go view that. Brian, thanks for being here.
All right.